Greetings friends. Today we are going to have this session on an introduction to the income tax law in India. I am CEO Arun Agarwal and I hope to clarify the key issues in the income tax law as is applicable in India. Please note the disclaimer statement for this lecture. The students are advised to refer to the study material, including supplementary study material if any, and other relevant legislation for latest provisions amendments required for the forthcoming examination. The Income Tax Law in India undergoes a change annually with the passing of the Annual Finance Act on the 28th of February each year, which is also referred to as the Union Budget. The study of income tax law requires the complete understanding of the method of computing total income, which is the essence of the income tax law. The computation of income and the rates of applicable tax are changed every year in the Union Budget, hence the students should keep themselves informed of such changes. Quoting sections and subsections is not important. The key thing is to quote the right sections and subsections or not to quote the sections at all. Now we come to the basic need for taxes by any government. Taxes are the source of funding the expenditure of governments. In the context of India, the following are the categories of government expenditure. The first category comprises of the establishment cost of the government, which includes the salaries of government employees and other establishment costs, the administrative cost of running the government machinery. The second set of expenses that the government has to incur is on the armed forces. Maintaining the armed forces for any country is an expensive affair, and the expenditure incurred by the government needs to be met through revenues. The third element of expenditure is the funding for the public sector undertakings, such as Indian Railways, Posts and Telegraphs. These public sector undertakings are actually intended to provide service to the people of India, and they are not driven by profit motives. Hence, their expenditure needs to be supplemented through government funding. And finally, the government incurs a huge expenditure on its programs and policies, such as food bill, Manrega, road construction and other projects of the government. It is in order to meet the expenditure for all these government expenses that there is a need for imposing taxes on the citizens and on the residents of the country. Now the government has different types of taxes which are levied on the people in order to meet its expenditure. All those taxes can be categorized under two broad categories. We have direct tax category, which is distinguished by the feature that it is paid by the person who is meant to bear the incidence of such tax. It is collected by the government directly from the persons who are meant to bear these taxes. The second category comprises of indirect taxes. These are taxes which are paid by one person to the government, but the incidence of such taxes falls on the other persons. These taxes are collected by the government indirectly from persons other than those on whom the incidence of these taxes are meant to fall. Examples of direct taxes are income tax, gift tax, wealth tax. Examples of indirect taxes are sales tax and VAT, excise duty, customs duty, service tax, entertainment tax, etc. Now under the income tax law, the term person has been defined to include the following entities: individuals, including non-residents, Hindu undivided families, bodies of individuals, associations of persons and artificial judicial persons, societies and charitable or religious trusts, partnership firms irrespective of their income, cooperative societies, companies incorporated under the Companies Act, local authorities like Panchayat, Municipal Corporation, etc. The importance of understanding the definition of person is fairly high because income tax is levied on a person. Therefore, if an entity falls within the definition of a person, it is liable to pay tax. If it does not fall within the entity of a person, then it is outside the purview of income tax. Therefore, the income tax law has defined the term person. The term person has been defined in the Income Tax Act to identify the entities who are liable to pay income tax under the Act. Similarly, the word SSE has been defined under Section 2, Subsection 7 of the Income Tax Act 1961. The term SSE means a person by whom any tax or any other sum of money is payable under this Act, and includes every person in respect of whom any proceeding under the Act has been taken for the assessment of his income or assessment of fringe benefits or of the income of any other person in respect of which he is assessable, or of the loss sustained by him or by such other person, or of the amount of refund due to him or to such other person, or who is deemed to be an SSE under the provision of this Act, or who is deemed to be an SSE in default under the provision of this Act. Therefore, we must understand that the word SSE does not mean only a person who is depositing income tax with the government. SSE includes other people as well who are in some way associated with the application of the Income Tax Law, Income Tax Act. It includes persons who are deemed SSEs or who are deemed SSEs in default. They also include persons against whom any proceedings under the Act have been initiated. The most important terms in the income tax law in India are the previous year and assessment year. Under Section 3 of the Income Tax Act 1961, previous year means the financial year immediately preceding the assessment year, provided that in the case of a business or profession which is newly set up or a source of income which has newly come into existence in the said financial year, the previous year shall be the period starting with the date of setting up of the business or profession and ending on the date of the said financial year. Therefore, if a business is set up on 1st July 2014, the previous year will be 1st July 2014 to 31st March 2015. This means that the previous year can be for a period of less than 12 months, but this will be only in the initial first year of the company, of the SSE. Under Section 2, Subsection 9 of the Income Tax Act 1961, assessment year means the period of 12 months commencing on the first day of April every year. Now, therefore, we must understand, the previous year means the financial year immediately preceding the assessment year. Therefore, and the assessment year starts from 1st April and ends on 31st March. Therefore, assessment year represents the financial year of the government, and previous year represents the year for which income tax is computed. It must be noted and understood that the income earned during the previous year is taxed at the rates applicable in the relevant assessment year. Now, the issue of relevance of previous year and assessment year arises. Previous year is the period in respect of which taxable income is computed for an SSE, whereas the assessment year is the year which governs the taxability of such income. Thus, for a salaried person, the previous year is the financial year starting from 1st April every year and ending on 31st March of the next year. For every other SSE, the previous year will be generally the same period as the financial year, except in the case of a new business, in which case the previous year will be from the date of start of business up to 31st March next. The current previous year is from 1st April 2014 to 31st March 2015. This is the previous year that is going on as of date. The salaried persons will be required to compute their income which is taxable under the Act, which is called taxable income for the year 2014-15 according to the provisions of the Income Tax Act applicable for the assessment year 2015-16. So the income that is earned in the previous year 2014-15 will be taxed according to the assessment year 2015-16. The income tax law that will be applicable in an assessment year is as determined in the annual union budget which is announced on 28th February of each year. The provisions of Union Budget announced 2014 will be applicable for the assessment year 2015-16 and the previous year 2014-15. So I hope that this is clear. Let us take an example. A starts a business on 1st July 2014. Indicate the previous year of A and the assessment year relevant to that previous year. Also indicate the Union Budget which will determine the relevant assessment year in this case. The previous year of A will be from 1st July 2014 to 31st March 2015. That means it will be only for a period of 9 months. Why? Because the business was started on 1st July 2014 and the income started from that date. Income earned by him during this previous year, comprising of the period 1st July 2014 to 31st March 2015, will be taxed in the assessment year 2015-16. And the assessment year 2015-16 is governed by the provisions of the Union Budget, which was passed on 28th February 2014. Let us take another example. What is the current previous year and the assessment year for a salaried person? The current previous year of a salaried person is the financial year starting from 1st April 2014 and ending on 31st March 2015, which is called, we may also refer to it as the financial year 14-15. And the assessment year, since previous year is a year preceding the assessment year, therefore the assessment year will be one year later than the previous year, which will be 2015-16. So the current previous year is 14-15 and the current assessment year is 15-16. So income will be computed for the period 14-15 and the law of taxation will apply for the assessment year 2015-16. That is the fundamental difference between the previous year and the assessment year. Previous year determines the period for which income is computed, and assessment year determines the taxable rates on which such income is taxed. Assessment year will always be the next financial year representing the previous year. We come to another very important chapter in income tax law, a very important topic, which is the residential status of an individual or of a company or of an entity in India. Understanding the residential status of a person under the Income Tax Act is extremely important, as the taxability of a person and the scope of his total income is computed on the basis of his residential status as defined under Section 6 of the Income Tax Act 1961. Under the Income Tax Act, the residential status of a person can be either of the following. He can be a resident in India, he can be a not ordinarily resident in India, or he may be a non-resident. So on the basis of residence, the residential status of a person will fall in one of the three categories, either as a resident or as a not ordinarily resident, and the third as non-resident. The residential status of a person is determined for each previous year and may vary from his status in the earlier previous year. So residential status is always seen in respect of each previous year before the income is computed for taxable purposes. If a person is resident in India in a previous year, relevant to an assessment year in respect of any source of income, he shall be deemed to be resident in India in the previous year, relevant to that assessment year in respect of every other source of income. Therefore, if a person is resident in India in respect of, let's say, salary income, then for that previous year, he will be resident SSE, he will be a resident in India in respect of every other income. It is not possible for a person to have different status of residence in respect of different types of income within the same previous year. Now let us look at the residential status of individual SSEs. In the case of individual SSEs, there are two basic conditions to be determined, and there are two additional conditions for determining the residential status. What are the basic conditions? Number one, the first basic condition is what is the stay of that person in India during the previous year. How many days in the previous year the individual has stayed in India. And the second basic condition is how many days in the preceding previous years has the SSC stayed in India. These are the two basic conditions. There are certain additional conditions that also apply. Additional condition 1 is how many days the person has been, the person has been resident in India in the last 10 preceding previous years. In other words, in the preceding 10 previous years, for how many previous years was the SSC a resident in India? Additional condition 2 states that the minimum stay in India in the last 7 preceding previous years. These are the two additional conditions and these are the two basic conditions. Now, what does the income tax law say regarding the status of residence in India? Conditions of residential status in India for individual SSCs only. The minimum stay in India during the previous year should be 182 days and during the 4 preceding previous years it should be 365 days. In the last 10 preceding previous years, the SSC must have been a resident of India for at least 2 years, and in the preceding 7 previous years, the SSC must have stayed in India for a period of at least 730 days. Now, these are the 4 conditions that have been laid down. In the case of an SSC who is a resident of India, he must fulfill at least one of these 2 conditions, the basic conditions. That means, for a person, for an individual to be resident in India, he must have been in India during the previous year for at least 182 days or he was in India during the preceding 4 previous years for 365 days. In addition to one of these 2 conditions, he must fulfill the other 2 conditions, both of these. So, he must have been a resident in India for at least 2 previous years in the preceding 10 previous years, and he must have been in India for a period of 730 days during the preceding 7 previous years. If he satisfies these conditions, he will be deemed to be a resident of India. The second category is that an individual is a resident in India, but he is not ordinarily resident in India. In that case, he must fulfill one of the basic conditions. That means he should have been in India for 182 days at least, or he must have been in India during the 4 preceding years for a period of 365 days in all. It is not necessary for him to be in India for a period of 365 days or 182 days continuously. It can be in small periods, but in aggregate they should add up to these numbers. And he will be a not ordinarily resident in India if he fulfills one of these conditions, but he does not fulfill both the other conditions. The additional conditions of at least being resident for 2 previous years in the preceding 10 years and being in India for 730 days in the preceding 7 previous years, he does not fulfill both these conditions. He may fulfill only one. In that case, he will be deemed to be a not ordinarily resident in India. And a person is non-resident in India if he does not fulfill any one of the basic conditions. That means he was not in India for 182 days during the previous year, and in the preceding 4 years he was not in India for 365 days. If he does not fulfill these conditions, then he is a non-resident, even if he may fulfill either one or both the additional conditions. If he does not fulfill any of the basic conditions, then he will be a non-resident in India. Let us look at the residential status of a Hindu undivided family. A Hindu undivided family or other association of persons is said to be resident in India in any previous year, in every case, except where during the relevant previous year, the control and management of its affairs was situated wholly outside India. Therefore, if the control and management of its affairs was situated even partly in India, it will be deemed to be resident. In the case of a Hindu undivided family or an association of persons, in order for that person to be resident in India, the management and control of its affairs is situated wholly or partly in India during the previous year. A Hindu undivided family or an association of persons will be not ordinarily resident in India if the Karta or the manager of the HUF satisfies both the additional conditions mentioned in the previous slide, that he has been a resident in India in 2 of the preceding 10 previous years and has been in India for a period of periods aggregating in all to 730 days during the 7 preceding previous years. In that case, the HUF will be treated as an not ordinarily resident in India, and an HUF or an association of persons will be non-resident in India if the management and control of its affairs are situated wholly outside India during the previous year. Now, the point to be noted here is that control and management means de facto control and management, and not merely the right to control and manage. Control and management is situated at a place where the head, the seat, and the directing power are situated. Let us look at the residential status of a company. In the case of a limited company, it will be a resident in India only under 2 conditions. Number 1, if it is an Indian company, it will always be resident in India. And what is an Indian company? An Indian company is a company which has been incorporated in India. Therefore, if a company has been incorporated in India, it will always be a resident company, resident SSE. In the case of a foreign company, it will be treated as resident in India only if the management and control of its affairs are situated wholly in India during the previous year. Therefore, unlike in the case of HUF or an association of persons, in the case of a foreign company, it will be treated as resident in India only if the management and control of its affairs are situated wholly in India. A company will not be having the status of a not ordinarily resident. A company can either be a resident in India or it can be a non-resident in India. So Indian companies cannot be non-resident. It is only the foreign company who will be non-resident, and a foreign company can be non-resident in India in a previous year if the management and control of its affairs are situated wholly or partly outside India during the previous year. Control and management means de facto control and management, and not merely the right to control or manage. Control and management is situated at a place where the head, the seat, and the directing power are situated. Therefore, control and management will be considered to be at a place where the decision making is vested. That is what determines where the company's control and management lies. Let us look at the residential status of the remaining SSEs, of other SSEs. Now, apart from the SSEs that we have seen before in the earlier slides, like individuals, like Hindu undivided families or other association of persons and limited companies, all other SSEs fall within this category as other SSEs. These SSEs can only be either residents or non-residents in India during the previous year. Such SSEs are resident in India if the management and control of its affairs, of their affairs, are situated wholly or partly in India during the previous year, and they will be deemed to be non-resident in India if the management and control of their affairs are situated wholly outside India during the previous year. Which means that in the case of all other SSEs, if the control and management of their affairs is situated even partly in India during the previous year, they will be deemed to be resident in India in that previous year. And if the control and management of their affairs is situated wholly outside India, it is only then that they will be treated as non-resident for that particular previous year. Let us look at an example here. From the following residential data of Mr. A in India, determine the residential status of Mr. A for the assessment year 2015-16. Now, the assessment year 2015-16 means that the previous year applicable to Mr. A will be 2014-15. So let us look at the residential status of Mr. A for the previous year 2014-15, which will have to be determined by taking the following steps. The first step is, how many days in the previous year was Mr. A resident in India? He was resident in India in 2014-15 for 177 days. Then, how many days was he resident in India during the 4 preceding previous years? He was resident in India for 40 days, 200 days, 130 days, 45 days. If you add these up, you get 415 days. So both these conditions, here he was in India for less than 182 days, but here he met the other basic condition of being in India for 365 days. He was here for 415 days. Now let us look at the period of stay in India during the preceding 7 previous years. It is 40 plus 200 plus 130 plus 45 plus 75 plus 186 plus 183. So during the preceding 7 years, he was in India for 859. From the above, Mr. A fulfills one of the 2 basic conditions, and he also fulfills the condition of being in India during 730 days or more during the preceding 7 years. Therefore, if we presume, there is a reasonable ground of presumption that he would have been resident in India in at least 2 years out of the preceding 10 years. Therefore, we may conclude that Mr. A is a resident in India in the previous year 2014-15, which is taxable in the assessment year 2015-16. Looking to the next question, X Limited was incorporated in New York in 2012. In June 2013, it set up business office in New Delhi. The business office in Delhi manages an auto parts plant set up in March 2014, which started commercial production on 1st June 2014. The company is managed by the board of directors who are based in New York. However, the company has posted a managing director for heading its Indian operations, a CFO and a legal advisor who are all members of the management committee, which reports to the board of directors, which is based in New York and works under its supervision. Determine the residential status of X Limited for the previous year 2014-15. Now, under Section 6 of the Income Tax Act 1961, a company incorporated in India is resident in India in all cases. But a company which is incorporated outside India is resident in India if the management and control of its affairs is situated wholly in India. In the given case, X Limited is a foreign company because it is incorporated in New York. Hence, X will be resident in India only if the whole of its affairs are managed and controlled in India. In the case of X Limited, although the management committee exists in India, it operates under the supervision and control of its board of directors, which is based in New York. Hence, the management and supervision of X Limited is based outside India. In view of the above reasons, X Limited will be treated as non-resident in India in the previous year 2014-15. So the key points that you have to remember is, where was the company incorporated? It was incorporated in New York. Therefore, it is a foreign company. Now, if it is a foreign company, it can be resident in India only if the control and management of its affairs is situated wholly in India. Now, how do you determine where the management and control of its affairs is situated? By looking at where the decision-making body of the company is. Now, in this case, it is very clearly mentioned that there is a managing director who is posted in India, there is a CFO and a legal advisor. They are also part of member management committee and they are based in India. But this management committee works under the supervision and direction of the board of directors, which is based in New York. Therefore, although the management committee is based in India, the control and management of the affairs of X Limited is based in New York, because the management committee does not operate independently of the board of directors. It works directly under its supervision. It is for this reason that we may conclude that the control and management of its affairs is situated outside India and it is a non-resident SSE in India. Now we look at the scope of total income. The scope of total income of a person under the Income Tax Act 1961 depends on his residential status in India during the previous year. Under Section 5, Subsection 1 of the Income Tax Act, the total income of any previous year of a person who is resident in India includes all income from whatever source derived which is received or deemed to be received in India in such year by or on behalf of such person, or which accrues or arises or is deemed to accrue or arise to him in India during such year, or accrues or arise to him outside India during the said previous year. Under the proviso to Section 5, Subsection 1, the total income of a person who is not ordinarily resident in India, the income which accrues or arises to him outside India shall not be so included unless it is derived from a business which is controlled in or a profession which is set up in India. Therefore, in the case of a company which is in the case of an SSE who is a resident, his global income is taxable in India. In the case of a resident, his global income is taxed in India. In the case of an not ordinarily resident SSE in India, his income from India is taxable and his outside income is taxable in India only in respect of a business which is controlled in or a profession which is set up in India. Now if we look at the taxability under Section 5, Subsection 2 of the Income Tax Act, the total income of any previous year of a person who is a non-resident includes all income from whatever source derived which is received or is deemed to be received in India in such year by or on behalf of such person, or accrues or arises or is deemed to accrue or arise to him in India during such year. Therefore, in the case of a non-resident, only his Indian income is taxed in India. His global income is not taxed in India. In terms of the explanation of the first explanation of the above section, it is clarified that income accruing or arising outside India shall not be deemed to be received in India within the meaning of this section by reason merely of the fact that it is taken into account in the balance sheet prepared in India. In terms of the second explanation of the section, for the removal of doubts, it is further clarified that income which has been included in the total income of a person on the basis that it has accrued or arisen or is deemed to have accrued or arisen to him shall not again be so included on the basis that it is received or deemed to be received by him in India. So, if an income is included as accrued or having accrued, it cannot be added again when it is received. At one point it was accrued, at another point of time it was received. It will be taxed only once. If it has been taxed at the point of accrual, it will not be taxed at the point of receipt. Let us now summarize the scope of total income in respect of the different category of SSEs and in respect of different incomes. Let us first come to Indian income. Indian income is taxable in respect of all SSEs, whether they are residents, not ordinarily residents or non-residents. The second category is foreign income. Now foreign income arising from business which is controlled wholly or partly in India is taxable in the case of residents and not ordinarily residents, but it is not taxable in the case of non-residents. In the case of business income which is controlled from outside India, it is taxable in the hands of residents, but it is not taxable at the hands of not ordinarily residents and non-residents. Income from profession which is set up in India is taxable in the case of all the three categories of SSEs. It is taxable for residents, not ordinarily residents and non-residents, if the profession has been set up in India. Income from profession which is set up outside India is taxable in the case of residents, but not taxable in the case of not ordinarily residents and non-residents. In the case of any other foreign income, like rent, salary, interest, etc., they are taxable at the hands of residents, but they are not taxable at the hands of either not ordinarily residents or non-residents. Therefore, you will notice that in the case of resident SSEs, their worldwide income is taxed in India. In the case of the other two categories, it is only income which is earned in India that is taxable in India, and foreign income is taxed only when it is from a business or profession which is based in India and from which it is generated. In the case of non-resident, it is only the Indian income which is taxable. And if you look at the all other residual types of SSEs, who can either be residents or non-residents, they cannot be not ordinarily residents. For them, Indian income is taxable to both residents and to non-residents. Foreign income is taxable only in the hands of residents, but it is not taxable in the case of non-residents. Let us look at the Indian and foreign income and their taxability, the various situations when income is earned. If income is received in India and it has also accrued or arisen in India during the previous year, that is one situation of the income being earned. The second situation is income accruing or arising outside India, but which is received in India during the previous year. The third category is income accruing or arising in India, but received outside India. And the fourth category is income accruing or arising or deemed to accrue or arise outside India and received outside India in the previous year. Now, from the classification of income, the income which has accrued and been received in India, which has accrued outside India but received in India, which has accrued in India but received outside India will fall within the category of Indian income. And foreign income will comprise of the income which has accrued outside India and received outside India. Let us now look at the composition of total income. Under the income tax law, all incomes which are taxable at the hands of an SSE have been classified or grouped under 5 heads. These are income from salaries, income from house property, profits and gains from business and profession, capital gains, and income from other sources. All income which is taxed under the Indian income tax law has to be fitted into one of these heads of income. The aggregate of the taxable income under each of the above 5 heads of income is called gross total income. Therefore, the first step is to compute the net taxable income under each of these 5 heads of income. And when we add those net incomes, we arrive at the gross total income of the individual or of the SSE. From the gross total income, there is a deduction. There is a set of deductions which is allowed under section 80C to 80U. These deductions are allowed to arrive at the total income or the total taxable income of the SSE during that previous year. Now, let us look at the computation of taxable income under a given head of income. The taxable income under any particular head of income is calculated as under taxable income under the particular head as computed in accordance with the income tax law, less deductions allowed under the particular head in accordance with the income tax law. Therefore, the first step is to tax an income. The income tax law has clearly laid down under each head of income what incomes can be taxed under that head of income. So the first thing is that we group that income, that set of income which is taxed under a particular head, and then we allow deductions which are allowed in the computation of income of that particular head. Deductions under the Income Tax Act are allowed under 2 categories. What are those categories? What are those 2 heads or 2 categories? Deductions allowed under each head of income and deduction allowed from gross total income for computation of income tax. So, under the income tax law, deductions are allowed under 2 broad categories. One set of deductions comprise of those deductions which are allowed under the individual heads of income. So we have some deductions which are allowed under the head house property, profits and gains. Each head has its own set of deductions. The second category of deductions comprises of those deductions which are allowed from the gross total income in order to arrive at the taxable income. There is also in the income tax law a section which comprises of exemptions. Exemptions constitute a very major element of the income tax law. Exemptions are those incomes which are not taxable to the extent specified in the Income Tax Act. Exemptions are allowed under 2 categories as under those exemptions which are allowed in computing incomes under different heads of income, such as exemptions in respect of HRA, gratuity, commuted pension, etc. These exemptions are allowed in the computation of income under the head salaries. and those exemptions which are allowed and which are of a general nature and they are not governed under any particular head of income. For example, agricultural income is exempt from tax. Now, this is not relevant to any particular head of income. Deductions are first included in income and then they are removed or deducted from the same. In other words, deductions are shown as reductions of incomes, whereas exemptions are not included in the income in the first place. Hence, whereas deductions are shown as reductions of income in the income tax returns, the exemptions are just ignored and not taken in the computation of income at all to the extent to which they apply. Finally, there is a third kind of relief which is called rebate from tax or simply rebate. The third kind of concession or relief under the income tax law comprises of rebates. Rebates are deductions which are allowed from the amount of tax payable by the SSC. In other words, first the income tax payable is computed for the relevant previous year and then the amount of rebate allowed is deducted therefrom to arrive at the final tax payable by the SSC. Now, please understand that the difference between a deduction and a rebate is that deduction is allowed from income and rebate is allowed from the amount of tax payable by the SSC. Let's look at the summary of relief and concessions which are allowed under the income tax law. First, we talk of exemptions. These are those incomes which are exempt from tax to the extent specified in the Income Tax Act. These incomes are not included in the computation of income to the extent that they are exempt. The second category comprises of deductions. These are those amounts which are allowed to be deducted from the income of the SSC. These are broadly of two types: deductions allowed under each head of income and deductions allowed from the gross total income. The third category comprises of rebates. These are those amounts which are deductible from the amount of income tax payable by the SSC during the particular previous year. So these are the different types of reliefs or concessions which are allowed under the income tax law in India. Now, in order to understand the different kinds of reliefs and concessions which are allowed under the income tax law, let us look at a few examples under each category. Therefore, the fifth question asks you to give a few examples of incomes which are exempt from income tax, deductions from gross total income, and deductions from income from house property, just as an example of deductions allowed under a particular head of income. Now, incomes which are exempt from income tax are provided for in Section 10 of the Income Tax Act, and some of such exempt incomes are house rent allowance, gratuity, agricultural income. These are some of the examples, not an exhaustive list. Deductions from gross total income are allowed under Sections 80C to 80U of the Income Tax Act, and some deductions from gross total income are as under: life insurance premium paid by the SSC in the previous year, medical insurance premium paid by the SSC during the previous year, principal and interest on housing loan paid by the SSC in the previous year. Now, these are examples of deductions allowed from the gross total income of an SSC in the computation of his total income. Now, deductions which are allowed in the computation of income from house property are standard deduction of 30% of the annual value, interest on monies borrowed for constructing or buying the house. Now, these are examples of the different categories of concessions and exemptions that are available to an SSC under the Income Tax Act, and their treatment is quite distinct. Incomes which are exempt are not included in the income in the first place to the extent to which they are exempt. In the case of deductions from gross total income, they are deductible from the gross total income and they are not deductible in the computation of taxable income under any head of income. And the third category comprises of those deductions which are applicable to the computation of tax under a given head of income. Just to conclude, let us summarize the entire session that we have had so far. In the introduction to income tax law in India, therefore, the most important things that are meant to be kept in mind are the previous year and assessment year distinction. Income is computed for the previous year and it is taxed in the assessment year. The second category is, the second most important thing to understand in the income tax law is how to determine the residential status of an SSE, as the residential status of the SSE determines the scope of his total income during the previous year that is being considered. The third important thing that is to be understood in the income tax law is how to compute the taxable income under the different heads of income. In other words, the distinction of income into the different heads of income is very important, and understanding what income is taxed under which head is of a very important nature in the understanding of the income tax law in India. Now the next category comprises of computing the gross total income. The gross total income of an SSE is equal to the sum total of the net taxable income under each head of income. And finally, in the income tax law, the most important thing is understanding the different categories of reliefs and concessions that are allowed under the income tax law. These are allowed in the form of exemptions, in the form of deductions. Deductions are allowed in the form of deductions from gross total income or deductions in the computation of income under a particular head of income. And finally, there is a great relief, or there is a relief which is allowed, which in the form of rebate. Rebates are allowed as deductions from the amount of tax payable by the SSE during the assessment year in respect of a given previous year. So rebate is an amount which is deducted from the tax payable and not from any income. Thank you very much. I hope that you have been able to understand